Chapter 1. What was the most important thing that we can take from Chapter 1? Chapter 1 was overview of financial reports. What we learned there? We learned that the financial reports are prepared mainly for the investor and creditors. Managers are also fall in this category, but for the managers, we're going to prepare later on in the course, you're going to see those management reports, which are going to help them to make decisions. We have to consider all the stakeholders in mind, which employee, management, auditors, potential investors, stock analysis, stock exchange regulators, shareholders, creditors, when we're preparing financial statements. How many financial statements we're going to prepare? Five financial statements. Which are the 5 financial statements? First one is the statement of income. Every company wants to see how much income they're generating during the period of operation. Second will be statement of changes in equity. Every owner or every shareholders, they want to see what's happened with their investment. Third, we're going to prepare the statement of financial positions for position to show them where the assets are, how much liability they have to pay with the assets, and how much left for the shareholders or the owners. Fourth statement is statement of the cash flow, and the last statement is note to financial statements. What's on the income statement? On income statement is revenue minus expenses. That's how we get income. Net income, we get it revenue minus expenses. Once we get that one, we're going to check how much is the share capital and how much the retained earnings is. After we figure out the equity, we're going to go and prepare the balance statement of financial position, or also called balance sheet. On the balance sheet, we're going to find that assets are always equal to liability and shareholders' equity, which is the basic accounting equation. Under the assets, we're going to have assets are the economic resources which are controlled by the company, which are already purchased by the company, and those are expected to generate future economic benefits for the company in forms of revenue or sales. Two main category assets, current assets and long-term assets. Liabilities. A liability is the current obligation of the entity which has to be paid in the future with outflow of economic resources, which is due to the past events. So in the past, you do something which you have to pay in the future today. We have 3 types of liability. One is the, 2 types of liability, long-term and short-term liability. Same with the assets. Short-term liability, long-term liability. Short-term assets, long-term assets. Shareholders' equity. In shareholders' equity, again, we have the share capital and retained earnings, which is repetition. Now, what else is the equity? Equity represents asset minus liability. Or, in other words, we said the equity is represent the net assets of the company. What is the net asset? Net asset is the asset that's gonna stay in the company after the company cover its liability. Share capital is the capital that the owner invested. How about the retained earnings? Well, the retained earnings is the tricky part. Now, the retained earnings, what we're going to do in the retained earnings, we have to calculate first. We have to see how much the retained earnings from the previous year. And then we're going to see how much is the net income from the current year. And we're going to deduct any dividend that has been declared or paid for the company. So retained earnings, in other words, represents the net income, which stays or is retained by the company, minus dividend that has been paid. The fourth statement is a statement of cash flows. We have three sections there. There are four, but mainly there are three to show the cash from activities. Which activities? First is operating activity. Second is the investing activity. And the third one is the financing activities. This fourth section is just the net change in cash. The last one is not the financial statements. So what's the most important thing from chapter 1? You to know how to calculate net income, which is revenue minus expenses. Revenue minus expenses only, that's your net income. And the second thing is you to know how to calculate retained earnings, which retained earnings is beginning balance plus the net income from the period minus the dividend. So if this is the first year of operation of the company, the beginning balance retained earnings will be 0. So what you have to add? You have to add the net income and deduct the dividend. That's chapter 1. Now let's go and see what's the most important from chapter 2. In chapter 2, what we learned? We learned that in order to prepare the financial statements, we have to follow certain rules. What are those rules? Those rules depends on the company and what kind of company we have to report for. There are two types, public companies and private companies. So for the public companies, we're going to share, sorry, not this one. Let's stop sharing this one. Let's go to this. For the public companies, we're going to use International Financial Reporting Standards, where for the private company, we're going to use Accounting Standards for the Private Enterprises. Who's going to set those standards? Different accounting standard boards, which have in mind their foundation characteristics, which represents fundamental qualitative characteristics and enhancing qualitative characteristics, which are the foundation again for the financial statements. We're going to see there going concern principles. We're going to see accrual versus cash basis accounting. We're going to see revenue recognition when we're recognizing the revenue. The most important thing is you to keep the accounting equation in balance. Asset always to be equal to liability plus shareholders' equity. How to calculate the retained earnings? Again, for retained earnings, you have to do two calculations. First, you have to do calculation for the net income, and then you have to calculate the retained earnings. So again, if you have to calculate the retained earnings, you have to first calculate the net income, which is revenue minus expenses. Get the net income, then add the net income that you're going to receive at the beginning or opening balance of the retained earnings. Deduct the dividend, then you're going to see the ending balance for the retained earnings. If you have to calculate only the net income, then you don't need the dividend, you don't need the retained earnings opening balance. You just need revenue and expenses. So obviously net income, it will be way more simple to calculate rather than retained earnings, because in the retained earnings, you still have to calculate the net income and add the beginning balance, deduct the dividend. And what we did last time, we start going over the transactions by keeping in mind that always have to keep accounting equation in balance. Means asset always to be equal to liability and shareholders' equity, and at least two accounts are affected in every transaction. So we went over number of transactions. Exact number was 17 transactions. And once we all went over those 70 transactions, we have something like this, on which you can clearly see that at the end, when we finish everything, we found out how much cash we have, how much accounts receivable we have at the end of the period, how much assets, inventory we have, how much prepaid insurance, left how much equipment we have, less amortization, how much land we have. And what's the value of the total assets? Well, what's the cost, more likely, for the total assets? Value is different thing. Then we saw what kind of liability we have: accounts payable, interest payable, bank loan payable, and equity section. We have common shares and retained earnings. And we found out that the assets are always equal to the liability plus owner's equity. Then we start preparing the statements in the order that you see it: statement of income, statement of changes of equity, statement of financial position, and statement of cash flows. That's the only one that we haven't prepared. Statement of income, again, simply shows calculation between revenue and expenses. So we have the revenue, sales revenue, and we have number of expenses, and we get the net income. After we get the net income, we prepare statement of owner's equity. On statement of owner's equity, we show the common shares, and we show the retained earnings, which retained earnings is the income from the income statement, 7,400, less the dividend of 400 that we pay, and total retained earnings at the end of the period was $7,000. Then we prepare the statement of financial position. We show the assets as a current and non-current assets. Calculate the total assets. Then we prepare the statement, the other side of the equation of the statement of financial position, which is liability and equity, and we show the liability in form of current liabilities and non-current liabilities, and shareholders' equity, again, common shares and retained earnings. Statement of the cash flow, 3 sections: operating activity, investing activity, financing activity. And see here, you can see the 4th section, but let's say there's like only three cash flows that we're chasing. Operating activity is the most important one, because shows the ability of the company to generate cash from the operations, the main operations. Then we saw that the company invested in equipment and land, and the company generating the capital from issuing the shares and borrowing money from the bank. Also, the company paid dividend to the shareholders. So the 4th section is right here, which is the net change in the cash and explanation what's happened with the cash. So from the balance sheet, we can see that cash at the end of the period was $113,200, when the beginning of the period of January 1st, since we opened the company, the cash was zero. So the cash flow statement is going to explain how from zero become 113,200 by those 3 sections: section A plus B plus C. Some ratios, we calculate some ratio, but no ratio again, we're going to spend more time next time. Profit margin ratio, some return on equity ratio, and some return on assets ratio. And that was chapter 2. Now, again, the most important thing here is you to remember the statements, which comes first, what's the order of the preparation of the statements, and again and again and again, how to calculate this: retained earnings and net income. Net income, again, is revenue minus expenses, where the retained earnings is the opening plus the net income minus the dividend. So now let's move to the chapter that is our objective for the lecture on Friday and the lecture today. Long-term assets. Long-term assets, as you can see, that's one of the element of the assets in the company. The other element is the short-term assets or current assets. We saw that there are a few types of assets, not three, few types of assets. One is the property, plant, and equipment, which including all the tangible assets what have a physical presence, including the land, building, and machinery. Then we saw that there's a right of use assets, which is the again tangible assets, which are controlled by the company but not owned by the company. Company just temporarily control those assets, but they're not owned by the company. Those are the rights of use, which are assets under lease. Intangible assets are everything that has no physical presence. Then we have a goodwill. For the goodwill, I told you the goodwill is the difference between the purchase price and the actual assets that you're getting when you're purchasing company. And biological assets, we're talking about now plants and animals, are the last form of the assets which we can find on the statement of financial position. Why those are significant? The assets are significant because they're the one who generate future revenues. How are we gonna evaluate those assets? We have two methods. One is the cost method or cost model and the revaluation model. What was interesting on the cost model always and always keep the original cost less the accumulated depreciation and less accumulated impairment loss. So basically, we're always going to find on the statement of the financial position the carrying amount of the asset, which again is the original cost minus accumulated depreciation and minus accumulated impairment loss. Obviously, that will not show what's the fair value of the asset or how much the asset worth. Carrying amount again, asset less accumulated depreciation, which in this case act as a contra account to the asset account. Now, what's cost? In your assignment, I already saw in your assignment, you have to come up with the cost in some instances. So the cost of the asset always going to be purchase price, definitely, but not only. Any non-refundable taxes, dues, which are related to the purchase price, any legal cost associated with the purchase, any shipping transportation cost related to the purchase and bringing the assets for the intended use, plus any site preparation, installation, and setup costs. Now, if you purchase a multiple assets for the single price, then we have to allocate that price to the assets using the fair value and the percentage. So we're going to use proportional method to assign the percentage of every each of the assets, and we're going to use that proportion to apply to the actual price that we pay to come up with the value. Revaluation method, what's interesting with the revaluation method was the revaluation method instead of cost using the fair value. The rest is the same, less any accumulated depreciation and less any accumulated impairment losses. But instead of cost, here we're using fair value. Once we start using this method, we have to do reevaluation every year or every 3 years. And if the company using this method for group of assets, has to apply this for every single asset. Depreciation. What's the depreciation? Depreciation is transferring the cost of the asset into the expenses when we start getting benefits from the assets in terms of revenue. So in order to determine how much is the depreciation for the period, we need three things. We need cost, which cost is not the purchase price, but non-refundable taxes plus legal costs plus shipping plus transportation plus site preparation and everything. Plus, we need to know, is there any residual value? A residual value will be the money that we can get at the end of the useful life of the asset if we sell the asset. Again, that's estimated residual value, and we're going to have estimated useful life. That will be period of time that we expect to use the asset if we measure it by year, or number of units that this we can produce with this asset over the period of time. Again, depreciation, depreciable amount, the amount that we have to depreciate, is the amount calculated by the cost minus estimated residual value. So we're not depreciating the residual value. That's why it's important we to estimate the residual value at the beginning, so we don't amortize it or not depreciate that amount. How many depreciation methods we have? We have three common depreciation methods. One is the straight line method. The other one is unit of production. And the last one is the declining balance method. What's the difference? Straight line method, we're calculating depreciation and we're using that straight line method for the assets which producing a relatively equal revenue over the years of their life. So we're trying to match the revenue, equal revenue with the equal expenses in form of depreciation over the same time. So for the straight line method, it will be the same amount over and over and over. But it's going to be limited only to the depreciable amount. Second method will be unit of production. Then we're going to see how many units we can produce with the asset over the life of the asset. We're going to calculate what's the depreciation related to production of one unit, and we're going to write that amount for every unit that we're producing during the period. Again, we cannot depreciate more than the depreciable amount. The last method that left is the declining balance method, on which method in the very beginning of the useful life of the machine, we're going to have a high depreciation expense, which slowly going to go down. But again, all the three methods, we're going to depreciate only depreciable amount. And under the three methods, we're going to leave the residual value as a carrying balance on the asset account. Again, three methods. It's going to bring you to the same point, from point A to point B, but different way. One will be the straight line. The other one will be fluctuating based on the activity or units of production. The last one is the high in the beginning, lower, relatively lower at the end. We use this calculation in class to come up with the straight line method, unit of production, and declining balance method. We had this asset for $50,000, which the estimated residual value was $5,000. We're using the asset over 5 years. So for the straight line method, we need the depreciable amount and we need the useful life. So depreciable amount, we're going to get it as a cost of the asset minus estimated residual value. Useful life is the number of years, and we come up with the calculation that we have to amortize every year, $9,000 per year. Objective is over the 5 years, we to reach $45,000 depreciation expense. which is equal to the depreciable amount that we have to transfer from the assets into the expenses. Carrying amount is the amount that we cannot go under, and that's always going to be the residual value of the asset. For the unit of production, what we needed to know the number of the units that that particular machine or equipment is going to produce. Once we find out that this machine is going to produce 22,500 units, that means we can amortize or depreciate the asset over 22,500 units. How are we going to do the calculation? Again, depreciable amount, which is cost minus the estimated residual value, divided by the total units that we're going to produce over the useful life of the machine. And we come up with the calculation for that. For every unit, when we produce 1 unit, we have to transfer $2 as expenses. Once we prepare the chart with the formula that applying $2 for every units produced, we see that over the life of the 5 years life of the machine, we actually produce exactly 22,500 units, and we depreciate $45,000 and $5,000 left as a carrying amount in the asset account. You cannot go over 22,500 units of usage. I mean, you can go, but you cannot depreciate for more than 22,500, because if you do that, your total depreciation expense is going to exceed $45,000. So that means you're going to exceed the depreciable amount, which you cannot. If you exceed the depreciable amount, ending carrying amount is going to go less than $5,000, which you cannot go less than $5,000 because that's the estimated residual value for the asset. Last method was the diminishing or declining method. For the declining method, what was the rule? The rule first is to determine the percentage which is related to depreciation of that asset. Second, to multiply that percentage based on the double declining or triple declining, what kind of method we're using. Then to apply that rate to the asset carrying amount. And the last thing is to remember that in the year when the depreciation expense exceed the total depreciation of $45,000, we have to manually adjusting the depreciation expense to match our objective, or to have exactly 45,000 accumulated depreciation over the life of the asset and leave $5,000 as an ending carrying amount. So in the last year, or the year that you see that the depreciation expense, when you add it, exceed the total depreciation expense of the amount that you want to achieve, you manually adjusting it, and you're not relying on the formula, you're just manually adjusting it to get the objectives or to have the ending balance that you want to have. The journal entry to record depreciation: debit depreciation expense, credit accumulated depreciation. Now we talk about what if the asset is purchased not in the beginning of the year or middle of the year. If it's in the middle of the year, you're going to have first year, you're going to have a fraction year. And the last year, you're going to have also fraction year, which is going to cover the amounts that you don't have in the very first year. In the middle, you're always going to have full year. What if the asset is purchased during the month? Now that will depend. The general rule here is if the asset is purchased between 1st and the 15th of the month, you consider that was purchased in the 1st. If the asset was purchased 15th to 30th of the month, 31st, then you start depreciation at the beginning of the next month. What's the rule that I'm using when I'm doing the accounting, well, when the asset is purchased on the month of the purchase, I'm not deducting depreciation. I'm starting depreciation next year. Sorry, not next year, next month. That's with depreciation if we have the partial, but I told you that depends. You always have to consider the size of the company, total amount of the depreciation, effect that you're going to have on the financial statements, and what the users of the financial statements looking for. Those are very important things before you decide how to treat the depreciation and how to start expensing the depreciation expense. Now, is depreciation the same for the tax purposes? No, it's not. I believe at this point we're catching the slides where we are in the class. So, is depreciation the same as for tax purposes? No, it's not. Canada Revenue have special rules. What Canada Revenue doing is they saying, accountants, you are very clever and very smart. You have so many methods of depreciation. That's wonderful. We don't trust you. We don't believe you. So in order to make it equal all across the country, any depreciation that you already deducted, add it back. And we're going to tell you exactly how much to deduct. And whatever you're deducting, we're going to call it capital cost allowance. Now, the capital cost allowance, and that's depreciation or kind of depreciation, but that's the reduction of the value of the asset, which actually is allowed by Canada Revenue. Canada Revenue using percentage. So they're grouping all the assets in the class of assets. They put it in the class, which applying the percentage. They ignore the residual value. There's no, for tax purposes, there's no such thing as residual value. And they always show you every year how much maximum you can deduct. You can deduct less, but you always calculate the maximum. Now, can I change my depreciation method? Is there anything that I can change during the life? Once I start using, let's say we start using the straight line method, and can I change anything? Yes, you can. What can change? Well, it depends. Sometimes you can change your estimations. Don't forget, we estimating the residual value and estimating the useful life. Any of those estimations can change. What's going to happen if that actually change? Well, in this case here, what happened is that let's see. Assume that the equipment have been depreciated using straight line method. So basically every year we deducted 9,000, 9,000, 9,000. Management then decided that the equipment has 4 more years of useful life left at the end of the third year. Instead of having only 2 years to add it to 5, they said, no, it's not 5. They have only 2, they have 4 more. So what we have to do, and so instead of 5, they become 7. And the residual value at the end of the period is going to be 2,000. Instead of initially 5,000. So what we have to do, well, we have to increase the years and we have to reduce the residual value. When? At the end of the year that information become available. So we're going to use the previous year that we do the calculation for 2026. We've seen our carrying amount, 23,000. From the carrying amount, now we're going to deduct the new estimated residual value, 2,000. And whatever we receive as a number, that will be amount that we have to depreciate over the next 4 years. We come up with a new amount, we're adjusting the amortization schedule and keep going with the amortization. At the end of the day, don't forget, we have to meet our objective. At the end of the year 7, we have to have $2,000 carrying amount left in the account. So that means we have to amortize $48,000. Impairment. Can the asset be impaired? Yes, it can. When that happens, well, the management has to determine. Does the management think the asset is impaired or not? So, how are we gonna check that one? First, we're gonna check the carrying amount. Once we find out what's the carrying amount, let's say in this asset, let's say the carrying amount at year 3 is $23,000. But now the management thinking that we can get from this asset, if we're trying to sell it right now, we can get only $20,000. So what that means? That means that we have to compare the total of all the future cash flow that are expected to be generated from the asset. So we can generate $20,000. And so we have to calculate how much we expect to get from this asset. Well, that will be probably equal to the depreciation amount, depreciation amount that we have to depreciate every year. And then we have the asset fair value less selling cost. They estimated that the fair value less the selling cost is $20,000. So we're going to get the greater of those two amounts. And then we're going to compare the recoverable amount with the carrying amount. If the recoverable amount is more than the carrying amount, we're doing nothing. But if the recoverable amount is less of the carrying amount, then we have impairment loss. So as you can see in this case, at the end of the year 3, the carrying amount of the assets is $23,000. Management determined as a result of the damage, they can recover only and only $20,000. So do we have impairment loss? Yes, we do. How much is it? $3,000. So what we have to do, we have to reduce the carrying amount of the asset. We're gonna show that loss, and we're gonna create a new contra account for that equipment, which is gonna be called accumulated impairment losses. So how we're gonna present it? We're gonna present it like this. Equipment's gonna stay at the cost. Always. Then we're gonna have a depreciation, accumulated depreciation for that asset, $27,000. And then we're going to have a new contra account, which will be accumulated impairment losses for the same equipment. Total, as you can see, is $30,000. So the carrying amount of the equipment is only $20,000. Now, what's going to happen if we dispose this asset? Well, if we dispose it, we have to move it or derecognize it from our statement of financial position. How can we do that? Well, as you can see, that asset, let's say we, at this point, we want to dispose this equipment. We cannot use it anymore. It's totally damaged. We have to get rid of it. And we're not using it. So obviously, at this point, we have to write off the equipment. Any accumulated depreciation up to this point has to be written off. Any accumulated impairment losses written off. And we're going to show loss of $20,000, which we cannot recover or we cannot depreciate because the asset is damaged. And we're done. The other option that we may have is to sell the asset for 15,000 equipment for $15,000. So if that's the case, then we're gonna get $5,000 loss. We're gonna recover out of 20, we're gonna recover 15, and $5 will be our loss. Now, before we do that, before we do the calculation, what we have to do is the first rule when we disposing the asset is we have to update the depreciation. The example that I give you with these numbers is if we sell the asset at December 31st, year 3. But since that's never going to happen, let's say we're selling the asset in June next year. First thing that we have to do is to add the depreciation from January to June. Then we're going to remove the asset completely. We're going to check accumulated depreciation. Going to remove the accumulated depreciation. If there's any accumulated impairment to that equipment, we're also going to remove that one. We're going to check how much, and that we're going to give, once we get the calculation between equipment, less accumulated depreciation, less accumulated impairment of that equipment is going to give us the carrying amount. We're going to compare with the proceeds of sales or how much cash we get when we sell it. And either we're going to have gain, either we're going to have loss. Probably most realistic is you to have loss. But you never know. We have to see and wait and see what's going to happen the day of the sale. That's with the tangible assets. Let's move now to intangible assets. Intangible assets. What's the intangible assets? Those again assets which gonna provide the future benefits, but they're lacking physical form. They don't smell, you cannot touch them, you cannot see them. Now, if they develop internally, research has to be expense. If we have the research and development, research has to be expense. Development also has to be expense unless 6 specific criteria are met. If one of those criteria are not met, doesn't qualify for capitalization. Obviously, if it's purchase, that's a different story. We're directly capitalizing because we actually pay for it. Now, those are initially recorded at cost. And after that follow either cost method or model or revaluation model. You as a manager, you're the one who has to determine whether or not asset has indefinite life, means it's going to be used forever, or have a finite life or can be used for the period of time. Most likely, the legal life will exceed the useful life of those assets. Which are the type of the intangible assets we have? We have patents, we have trademarks, we have copyrights. Legal life is the maximum that you can use for the amortizing. And useful or economic life is generally used for calculation for the amortization. Trade secrets, that's a different category. There's no legal registration system in Canada for the trade secrets. So that is a little bit trickier as intangible assets. Now, the next category is the licenses, custom lease, and franchise rights. Those are other types of intangible assets. Computer software, definitely intangible assets, which can include web development cost And development cost, again, be careful with the development cost. Yes, there are intangible assets, but only and only if they meet all the 6 criteria, which are for development cost. If one criteria is not met, expense. Research, never capitalize. Once you see research, pure expense. How are we gonna amortize? Well, again, we need cost, we need estimated useful life, and we need the residual value if there's any residual value. Most likely we're going to use straight line method because those licenses, patents, they keep their value. So we slowly, year by year, same amount we deducting for our depreciation purposes or our expense purposes. Journal entry is very similar. It's actually the same like a property, plant, equipment, or tangible assets. Debit, amortization expense, credit, accumulated amortization. Let's see what the goodwill is now. Goodwill is separate category of assets, and the goodwill can be generated only and only when two businesses are combined together or one business purchases another business. That's the only instance where the goodwill is created. Now, the goodwill represents the consideration paid over the fair value of all assets and liabilities of the entity that you're purchasing. Now, the question is why somebody is willing to pay more than the fair value of what he purchased. Maybe, again, he's seeing something that's more valuable for him rather than the person that has it. The goodwill cannot be generated internally. So basically, it cannot happen by itself in the company. So only goodwill is creating when one business purchases another business and the consideration paid for that business is more than the fair value of the business. Let's see the example here. Let's see the purchase price. We paid purchase price of $2 million. The question is what we get. We get land with fair value of $900,000, building with fair value $500,000, equipment with fair value $300,000, inventory with fair value $150,000, patent with fair value $100,000, and liability current obligation $350. Fair value of the obligation is $350,000. In total, we get net assets of $1,600,000. So we pay $400,000 more than the fair value of the net assets. So now we having a goodwill of $400,000. How are we gonna see what's the current value of the goodwill? Current value of the goodwill always gonna be the current amount, the original amount of the goodwill, minus the accumulated impairment loss. So the goodwill, we're not amortizing the goodwill. There's no amortization in goodwill. The only thing that can happen with the goodwill is to be impaired. And once there's impairment of the goodwill, we're gonna show that impairment loss, which gonna reduce the value of the goodwill that we carry on our statement of financial position. Again, goodwill is not amortized and considered to have indefinite life. But for the accounting purposes, we're gonna test it every year for impairment. The objective is to write off the goodwill as soon as possible. That's the main objective here with the goodwills. We don't want to carry it forever on the statement of financial position. In fact, we want to get rid of it as soon as possible. Next group of assets, which is the big group of assets, that's right-of-use assets. Right-of-use assets, those are the assets which are currently under lease, or in other words, rented by the company, for which the company get the benefits of generating revenue or sales. Examples can be equipment, can be vehicles, can be retail, can be location, can be building, can be offices, can be airplanes, you name it. Now, once you sign that agreement gives you the full rights of the asset to use it the way you want to use it during the period of lease term. Same thing that if you get a car on lease, the car is under your name, you have the rights to use it, but it's still not yours. They're reporting on their carrying amount, and carrying amount again will be every of those right of use. We're going to have the cost. They're going to come with the cost, which we have to calculate, and then going to have depreciation or accumulated depreciation related to the every specific asset under the lease. Obviously, they're going to be recorded separately from the property, plant, and equipment because every creditor investors wants to see what's the value of the assets that this company actually leasing versus the asset that they actually owing. And by that, they can calculate they can see the liability which is related to that lease or how much of those assets are already being paid by the corporation, the company. Another category is, that will be the last category, is the biological assets. Biological assets are limited only and only to the plants and animals. Plants can be nursery tree, can be uh, blueberries, raspberry, cranberry, um, cherry trees, peaches trees, anything that produce make a production. Also can be winery, grape wines. Example for the animals can be fish farms, cows, poultries. Now, what's interesting here, once is harvest, biological assets become agricultural produce and eventually become inventory, which inventory we can sell. That's for the blueberry farm. They're reported at their fair value. And they also have estimated selling cost. So we're going to report it at the fair value minus estimated selling cost. And that's with biological assets. And there will be no test on biological assets. We just not mention it here for you, some managers, you to know that there's this type of asset which sitting on the statement of financial positions. Now, how are we going to measure those assets? Well, we're going to use different calculation here in forms of formulas and formulas of ratios. First one is the average age as a percentage and average age. Investors usually sometimes looking for that one, average age of the assets. And we can calculate it by that average age will be total accumulated depreciation divided by the depreciation expense. And the average age percentage will be total accumulated depreciation divided by total land and equipment minus the land. Why land is deducted? Because land doesn't depreciate. Why doesn't land doesn't depreciate? Because land is land, people. That rock that you see on the north with the two rocks that's called lions, those two rocks were there 250 million years ago, and they'll be there 250 million years after the human disappears. So for that reason, land doesn't depreciate. So we want to eliminate the effect, the cost of the land from our denominator. The other one is the future asset, fixed asset turnover. Fixed asset turnover will be the sales, how much sales you generating from your fixed assets only. So we're going to get the average net property, plant, and equipment only. We're not including here, as you can see, goodwill. We don't including our rights of use or assets under lease. We don't including biological assets. We're not including intangible assets. We're only including net of property, plant, and equipment. And net amount will be the cost less accumulated depreciation and less any accumulated impairment loss if there's any. And that's your chapter 4.
Yes, sir.
Yeah, let's do this question then together. What we have here? We have a depreciable asset, which come with the cost, comes with the residual value, and we have a useful life in number of years. Also, we have the estimated inputs, total estimated inputs that the asset can produce over the useful life of the asset, and the usage for the first year. We have to use the straight line method, unit of activity method, and calculate depreciation expense for the first year. So what's our starting point here? Obviously, we need to know the cost. So the easiest way to do it is from the slides, what we have to calculate first is the depreciable amount. Let me show it for you. This is what we have to get. We have to get the depreciable amount. How are we going to get depreciable amount? That's obviously cost less estimated residual value. How much is the cost for our asset? Do we know the cost? You can help me here with a little interaction, please.
Yes, we do.
Yes, we do. How much is that cost? 47,960. Right? We have that starting point. What else we need to know?
We have a residual value as well.
Estimated residual value. And that's estimated residual value. We already, oops, that's too much. Let's go here. The estimated residual value is $2,600. At this point, we can calculate the amount that we have to depreciate over the life of the asset, correct?
Yeah.
And that's equal to cost less estimated residual value. We have how much we need to depreciate. We know how much we need to depreciate. We know how much we have to leave as a carrying value on the asset, correct? So for the straight line method, let's go with the straight line method. For the straight line method, what we need to
Divide.
depreciable amount. We need the number of years, right?
Yeah, 6
Total
years.
years of usage. That will be 6 years. And then we can come up with depreciation per year. And how much will be that? This amount divided by 6. And we have the hour amount that we have to depreciate year after year after year after year. Can we do the depreciation schedule? Well, who's
Yes,
gonna
we can.
stop, right? Who's gonna stop us? Let's go year 1, year 2, and all the way to year 6. What we're gonna have the first column, that will be our beginning balance. Then we're gonna have depreciation, expense. Let's add here one column. And then we're gonna have accumulated depreciation. And we're gonna have ending balance. Those are the 4 columns that we need. Let's make it bigger now. It's this one and this one. And this one a little bit bigger, and probably this one a little bit bigger. Let's put it in the middle, and boom, we have our schedule. Do I know my beginning balance?
Yes, we do.
How much will be that?
Four
Our cost,
five
right? The cost will
four
be our
seven
beginning balance.
4796.
Right. At this point, right at this point, do I know my accumulated depreciation? How much should be my accumulated depreciation over the life of the asset?
It's 54360.
54360. So I know that amount. Do I know my ending balance on the carrying? So that will be
Yeah,
carrying amount.
Yes, we do.
I know,
260.
right? I know that amount.
Mm-hmm.
That will be 2600.
00. Yeah.
And I already know that those two amounts have to give me how much they have to give me. How much should be the total between those two? Equal to the cost of the asset, right?
Yes.
I know that. So what I have to be careful. Don't exceed this amount and don't go below this amount. That's a general
Yes.
rule here. So how much should I expect as a total depreciation expense when I
6
calculate it?
years.
That total depreciation expense should be equal to the depreciable amount, right? Same thing.
Okay.
Okay, let's go now. Depreciation expense first year. How much will be?
That's
7560.
divided by 6.
Right? This one. How this gonna change year over year? Is it gonna change?
It's a straight line.
Yes or no? Is it gonna change depreciation expense year after year after year after year?
No.
No, it's gonna stay the same, right? So I can easily drag this number all the way down, and I know all those years I have to depreciate that amount. In the depreciate this amount, I'm gonna depreciate exactly 45,360. Okay, I have it. So now, how much is accumulated depreciation first year? Well, equal to the depreciation first year. What will be the carrying amount of the asset? Will be beginning balance minus the depreciation for the period. Now the ending balance is going to become beginning balance, right?
Correct.
Accumulated depreciation is going to be accumulated depreciation from the first year plus second year. And the carrying amounts will be the same. Beginning balance minus the depreciation for the year. At this point, I can easily drag those formulas. The question is, did we get what we wanted?
Yes.
Yes, we did.
Yes. Just like that. So the last thing that we can do is to make it a little bit fancier. Let's put one net here. Let's put some colors here. Accumulated depreciation, let's put it blue. This one will be something like this. This one will be beginning balance. Let's put another one like this. And the year is gonna be something darker like this. And boom, we have a nice fancy chart for depreciation, right? So what we're gonna do, we're gonna keep using this chart for the next purpose, for the next thing that we have to do. What's the next thing that we have to do? We use the straight line method. Now what we have to do? Unit of production, unit of activity.
Yes.
Let's do it. What do we have to do? Get this information, copy it, and put it right here. And let's do some changes now. First, what we're gonna do? I'm gonna get rid of everything. However, we know our objective. What's our objective? Our objective is my total accumulated depreciation to reach this number, and my total depreciation expense to be this number. I know that. No questions about it. Make sense?
Yes.
So the other thing that I can do is let's get rid of this. And 1, 2, 3, I actually need a little bit more. Like this. And since I don't have this one, let's put it here and get this one. Yes. No, not like that. I don't want to copy it and have this information carried every time with me. Copy this and move it right here. Okay. So let's focus on the unit of activity. Of activity. So for unit activity, what do we need? What do we need? We need the total activity, right? How much is our total activity from this question? Do we have it?
Estimated units of output.
Or how many units we expect to produce?
75,600.
This machine have to produce 75,600 units over the 6 years of usage, right?
Correct.
So the question is, how much will be depreciation, actually, not per year anymore, per what? Per single activity,
Yes.
per activity. That's what we have to find out. What's our nominator and what's our denominator? Obviously, depreciable amount is our nominator. Number of units will be activity. Is that the one? Is that the right way to do it? I'm waiting for you to tell me.
Yes, it is.
It is the right way to do it. So
Yes.
cost divided by unit.
Unit.
Why? Because what we're chasing? We're chasing the cost per unit. So dollar divided by unit, cost per unit. So how much is the cost per unit? 60 cents. Make sense?
Correct.
So every time when you produce 1 unit, we have to transfer 60 cents as a depreciation expense. So far, so good, right? So let's insert another column here and move it a little bit to the right. What we're going to put here?
Is it the unit activity for
Unit of
each year?
activity, yeah, unit activity.
In progress.
And we have our depreciation expense per unit, right?
Correct.
Insert. Let's put it, push everything here down. Cancel this one. Let's push everything here down. To add another line here. What will be the depreciation expense per unit? That will be equal to 60 cents per unit, correct?
Correct.
Okay, beginning balance. What's our beginning balance?
45360.
Cost.
Oh, sorry, the cost.
Cost
47960.
is always beginning balance. Remember it. Cost is always beginning. There should be no hesitation, no questions with that. Then we need unit of activity first year. Do you know how many units we use it? We produce.
5400.
So 5,400. Next thing is to get the depreciation expense. Number of units time
60 cents.
60 cents.
It's 3240.
So how much is our depreciation expense first year? Same. Accumulated, the same one. Carrying amount, beginning balance minus depreciation expense. Can we fill the entire chart? Yes, we can. The only thing that we're missing is the information. So when I get the total here, how much should be my total?
The total depreciation
No,
amount.
unit of
Sorry, the
activity.
total
Unit-
activity is 75,600.
75,600. Can I go above?
No,
Well, technically you can produce more units, but don't add more depreciation.
I
Right?
see. Okay.
Yeah, you can produce 100 more units or 200 more units, but don't add more depreciation because this 60 cents is based on this number. And once you reach this number, you're stopping it. Because if
Okay.
you add more, then you're gonna move away from our objective. And our objective is to reach this amount as a total accumulated depreciation. And this amount as the ending balance. Make sense?
Makes sense.
All right. So let's use this one and produce another one. What will be the next one? What's the next method?
The double
Declining.
Diminishing.
double decline.
Declining method. Let's do this declining method. For declining method, what do we need? We need to do some adjustments, right? Let's close this one and let's get rid of this. Do we know how much should be my accumulated depreciation before I even start?
Yes, we do.
Yes. This one. How much will be my total? Same, right? That will be the same now. So I cannot exceed this amount. So my accumulated depreciation has to be this, and my carrying amount has to be 2,600. I cannot get any more than that.
Yes.
So once we know this, what do we need to know now? First thing what we have to calculate. First we have to check how many years we're going to use this asset, correct?
Correct.
Then we have to come up with the percentage per year. How are we going to get that percentage? And that will be equal to 1 divided by number of the years, which in this case is 6, correct?
Correct.
So what's our percentage per year? 1 divided by 6.
1/6.
It's going to be 0, but if we put the percentage, we're going to see. That's our percentage.
Yes.
So now what's the next objective? Depends which method we going to use. If we use the double declining, what do we have to do? Put number 2 here, and then we're going to be depreciation percentage will be this one times 2. So that will be our depreciation percentage, 33, 33. So what we have to do? Beginning balance here. Do we know my beginning balance?
Yes, we do.
Yes, I know.
47,960.
960. Do I know my depreciation percentage? That's what I know.
Yes, we
Yes,
do.
I know it. How much is it?
33.33.
33, 33. How this gonna change year after year? Is it gonna change? No,
No,
same percentage every year. So how much will be my depreciation expense then? Well, beginning balance times the percentage, right?
correct.
And we get the amount. How much will be my total accumulated depreciation? Same amount. First year will be the same. Carrying amount will be equal to beginning balance minus depreciation expense. We get the beginning balance. Let's check the next year. What's going to happen next year? Next year, we're going to start with this. We're going to apply the same percentage, this one time that percentage. We're going to have accumulated depreciation will be the first year plus second year. And our ending balance will be beginning balance minus depreciation expense. Then what we're going to do? We're going to drag the formulas and see what's going to happen. Did we reach our objective?
The depreciation carrying amount. Yeah, I think we did.
Yeah. Do we exceeding our objective? No.
No.
Do we have to make any adjustments here?
No.
No. Okay. Let's use this one and come up with something more interesting. What would be more interesting? Let's make a triple declining. Let's make something useful here. What means triple declining?
It'll be times 3.
Time 3. Once we put it times 3, our percentage will be 50% now. That's the depreciation that we have to use. So let's change this percentage here to be equal to this. And this percentage only. And let's change the entire calculation now. So what we have to see?
That we don't go over the accumulated depreciation amount.
And don't go less than?
The carrying amount.
Carrying amount. Did we went less?
Yes, we have.
Which year?
In
year 5.
Year 5.
What do we have to do? In year 5, we have to manually go and adjust it. What do we want our carrying value to be?
2,600.
Let's override it, 2,600. That's how much I want to be. How can I get it? What's my beginning balance? Do I know my beginning balance?
Yes, it's 2,997.50.
Do I know my ending balance? That one.
Yes.
Yes.
So if I deduct 3,907, 397.50, I'm gonna get what I want. How much will be my depreciation expense the last year?
0.
0. Did I reach my objective now?
Yes, we have.
So what we did in the year, when we see that the calculation exceed our objective, we manually overriding the numbers. We just taking over to get what we wanted. Did we get what we wanted?
Yes, we did.
Yes, we did. So can you use this one for any questions that you have for any of those scenarios? Yes, you can. Here, the only thing that you have to do is to plug the information for the unit. Okay, that's your question. I believe question number 8. Let's do question number 9. Question number 9 is more interesting, and we have to do all the calculation for everything. So, what I'm gonna do is I'm gonna flip this one here. I'm gonna name it question 2, and let's start plugging the information on the very top. Not like that, better be this one. Okay. I don't need this one, I don't need this one. And maybe I should enter a few more lines. So, get rid of this. Oops, I didn't delete everything. Let's go again. Yeah, that's better. Okay, and the last one is the company has December 31st year. Okay, we have our question, right? Don't forget, our objective is to get the depreciable amount first. So let's get rid of everything and see what we can get. First thing first, do I have the cost of my machine for the straight line method? If we have to do straight line method first. Let's get rid of those. We don't need those lines right now. What you guys gonna say? Can you guys hear me?
Sorry, I was on mute. Yes, we can.
Yes. Okay. So how much is the cost?
It is 151,000.
151.
Okay, that's our cost. Is there a residual value?
Yes, there is 11,000.
We have to deduct it, right?
Yes,
If we deduct 11,000, now how much we have to depreciate?
140,000.
$140,000. So before I even start any calculation, do I know how much should be my accumulated depreciation?
Yes, we do.
Do I know how much should be my carrying amount at the end of the period?
Yes, we do.
It's 11,000.
It's 11,000, yes.
Now, the next thing that I need to know is, do I know my expected useful life?
4 years.
So, let's do some adjustments here. We have to do some adjustments, right? Otherwise, it's not going to work. Let's get rid of this first. What do we have to do? We have to shrink the years, right? No, let's shrink it later. I'm gonna leave this one here. So, how many years we gonna use this machine?
4 years.
4 years. How much will be per year? This one divided by 4, right?
That's correct.
Divided by 4. 35,000 per year. So what I have to do? I have to get rid of those 2 columns. Let's get rid of those 2 columns. I need only 4 years. Something like that, right? Nothing more, nothing less. And I know my objective. My objective is to reach accumulated depreciation 140 and my carrying amount to be $11,000. That's all I want. Nothing more, nothing less. Correct?
Correct.
Okay. Beginning balance.
151,000.
It's gonna be the cost. Depreciation expense.
$35,000.
$35,000. Accumulated depreciation first year,
$35,000.
$35,000. Carrying amount first year, at the end of the first year, 51 minus
Minus
35,
35.
160. Next year, we're starting
116.
with the 16. Depreciation expense, let's lock it and let's drag it down. It will be 35, 35, 35. If we do 35 4 times, we're going to get 140, right?
140.
Okay. Then let's depreciation expense, accumulated depreciation, the second year will be 70,000. Balance will be beginning balance minus depreciation expense. And now I can drag the formulas since I have everything. Boom. Did we get what we wanted?
Yes, we did.
Yes, we did. So do I know my depreciation every year?
Yes, we do.
Yes, we
Yes.
do. Okay. So what's the next one? This one is done. Next one is unit of production. Let's get that unit of production. Let's hide those one for now. We don't need those one. Let's get rid of those. And let's open those sheets. So we can see what's happening here. Unit of production method. For the unit of production method, what do I need? Well, pretty much the same thing, right? Let's get rid of all those things. And I need here only 4 years. Let's get rid of those numbers and we start again. Start all over again. Cost. We have the cost 151. We have the estimated residual value 11,000. You see, my cost is already here. I already have it in my formula. But let's get rid of everything, so we don't have to we have to come up with everything together. So my depreciable amount, how much I have to depreciate?
$140,000.
$140,000.
Mm-hmm.
What's my total activity now?
200,000
200,000 components. So my total activity is 200,000. Now the question is, every time when I produce one component, how much depreciation I have to expense?
So it's 140 divided by 200,000.
That's exactly what it is. So every time when you produce one unit, one component, you have to expense 17 cents. What's the beginning balance?
151,000.
151,000. How much can be my total accumulated depreciation?
140,000.
140,000. How much has to be my carrying amount?
11,000.
11,000. And that's the only way that I can get total of 151,000, which is my cost. And total depreciation expense again cannot exceed depreciation expense when I get the total, it cannot exceed 140. Okay, so how much per unit? We already know 70 cents per unit. What do I need to find out? How many components I produce year one? Do we have that information?
Yes, we do.
Let's hide this one so we can see that thing. Okay, we do. How many units we produce first year?
That's 40,000.
40,000. Second year?
50,000.
50,000. Third year?
60,000.
60,000.
And 50,000.
50,000. How many units I can produce with this machine?
200,000.
Can I go more?
Yes, you can.
But can I deduct depreciation?
No.
No. Because those 70 cents are only and only based on the 200,000 units. So, depreciation expense first year,
Times
40,000
70,000.
times 70 cents. And I can easily log this 70 cents here. And from here, I can get my depreciation expense every year, correct?
That's correct.
Now, how much is my total depreciation expense? 140,000. Can you see it?
Yes, I can.
So now accumulated depreciation first year, 28. Carrying amount at the end of the first year, 151 minus 28. And we get it. Beginning balance, it's gonna be
123.
ending balance. Accumulated depreciation will be 28 plus 35. We got it. Ending balance will be 123 minus depreciation expense for the year. And now we can drag the formulas and get it all the way to the end. And we're done. Did we get what we wanted?
Yes, we did.
Yes, we did. And the last one is, the last thing that you have to do in this question is to get double declining method. So let's do the double declining now. We're not going to do the triple declining, only double declining, right? Let's free this one here. And one more. So what do we need? Same thing. We need our cost. How much was the cost?
151,000.
Just a second. Let me do first something before I continue. Let me hide those rows, and then I'm gonna open it again. So first one, we have 151,000. Something happened with my Excel spreadsheet. Now I cannot enter anything. Why is that? Let's try again. 151,000. Residual value, we have at 11,000. So we have to depreciate 140 over 4 years only. Let's get rid of those last 5 years. I don't need this information. I don't need the information. So what's the first thing that we have to do? How many years we're using the assets?
4 years.
4 years. Let's get rid of those one and this one. 4 years. How much will be percentage per year? 1 divided by 4. It's going to be 25%.
25%.
If we double it, we're going to get 25
50%.
times 2, 50%. And that's how much will be our percentage, right? Up to 50%.
Right.
So once I have my percentage, I can start doing the numbers. What's the beginning balance?
151,000.
151,000. So depreciation expense will be this one time 50%. And the first year depreciation accumulated will be the same. Carrying amount will be exactly the same. Right? What's my objective?
To get to a depreciable amount of 140.
140.
140,000, yeah.
Total accumulated will be 140,000. And the carrying amount should be 11,000. So, second year, this one, here will be 75 times 50%. Accumulated will be first year plus the second year. Carrying amount will be beginning balance minus the carry. And the depreciation expense, and we get it. Now I can drag the formulas, right? Are we okay?
We've gone over in the last year.
In the last year. So what we have to do in the last year, we have to do some changes.
Manual adjustments.
What will be that? What do I want to be my ending balance?
For accumulate.
9437.
But what do I want to be? What do I want to be my ending balance?
For carrying amount, it's 11,000.
11,000. That's
Yeah.
my objective here. So let's get 11,000. Let's get 11.
Depreciation.
So now I have to adjust this amount. So from 18,875 to bring me to 11, right?
Correct.
How much will be that? This one minus 11,000. Boom, done. Make sense?
Makes sense.
Okay. All right, so you have this calculation. And the last thing that left is the last question. So now I can open those ones so you can see them. And the last question is, let me check the last question quickly. Just give me a second. And probably I'm gonna have to hold you for a few minutes. I hope that's okay. Okay, let's see where we are. We are here, right? Okay. That's not what I want, but yeah, that should work. Can you guys see my sheet?
Yes, I can.
Okay, let me see if I can paste it. This one, no. This one, no. Okay, this will be the best that I can do. Or let me try something else. Just a second. Give me a second. Because I'm trying to copy it from the what I did with the previous group. See? No, it doesn't show. Okay, so what we can do is let's share this one. Can you guys see my screen?
Yes, I can.
Okay, let's go quickly over this. You're going to have this scenario, so you have to decide, is it part of the land, is it part of the building, is it equipment, is it land improvement, or is it expense? So first thing is we purchase a land, $450,000. What is this?
Land.
Land. So drop down, choose land. Done. Second one, there was a building on the land which we have to demolish.
Land improvement.
Hold on a second.
Oh,
can
sorry.
I use the land
Expenses,
if I don't? So listen, can I use the land if I don't move the building that was there?
You want to just use the land? No.
No, Professor, we
No.
can't use the land.
So what is going to be? Is it expense or is it part of the cost of the land? What is going to be?
Expense.
Again,
The objective is to
listen,
use the land.
land. Yes.
Yes.
Can I use the land?
No, you
Yes.
can't use
No,
the
No,
land.
you can use it.
No.
So is it going to be part of the cost of the land?
It's part of the cost of the land.
Yes.
It's part of the cost of the land. That's how you should put the question. Can I use the land? No. It's part of the cost. Now I have to level the land so I can use it. If I don't level the land, can I use it?
No.
No. So what will be the leveling of the land?
Improvement.
It's land.
Is it
It's
related
land
to the
again.
land itself?
Is
Is that leveling the land? Is it related to the land?
yes.
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 Can I use the land if I don't level it?
No.
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 No. So it's gonna be
Land.
cost of what?
Of
Land cost.
Cost
land.
of
For cost of the land.
land. Yeah.
All right. Now I start construction of the new building. What will be that?
It's an improvement on the land.
Improvement. Yeah.
No, new building. I'm doing construction of new building, people. What will be that?
It's building.
It's
Land.
building.
Buildings.
What I'm building?
Yeah.
I'm building.
Building.
Right.
Yeah.
Now, watch this. I'm doing paving on the parking lot, which is next to the building.
That's improvement.
Land.
Land
Land
improvement.
improvement, right?
Mhm.
Okay. That will be clearly a land improvement.
Land improvement.
Next. Now I'm doing decoration on the landscaping around the building.
That's improvement.
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 How much you spending? 6,000. So yes, it can be land improvement, definitely, but can be something else.
Expensive.
It can be expense as well, right? Now that will be depends on what how you're going to treat it, because landscaping around the building, what I'm planting
It's-
flowers.
It's like
Mm.
improvement. Planting
It
of flowers.
definitely is improvement, but can I can I expenses as well?
Yes.
Yeah, let's see what our options here. Do I have land improvements
Yeah,
by
land
itself?
Yeah.
expense or land improvement.
So that will
Expense.
be the best option. Either expense, either land improvement, right? Because I don't have option land improvement only. I can either go expense, either land improvement, so I'm choosing both. Make sense?
Yeah.
So I purchased new piece of equipment. What's that?
Equipment.
Expensive.
Equipment.
Equipment.
Mm.
Then I pay taxes on the new equipment. If I cannot recover the taxes, how should I treat those taxes?
Expenses.
Can I? Can I expense taxes which are related to my equipment?
No.
What should
So
I do?
Equipment.
Equipment.
It's gonna go with equipment. If I cannot recover it, the government not pay me back, I'm adding it to my equipment. That's become cost of the equipment. How about the GST? If I can recover it from the government is gonna pay me back the 6,000.
Mm.
What should I do? There will be no effect. It's not expense because I'm gonna get the money back from the government. I cannot add it to the equipment because again, government's gonna give me back the money. So there will be no effect here. So now I get the equipment, but I have to install it. Can I use the equipment if I don't install it?
No.
No. What will be the installation then?
Equipment.
Expenses.
Again, can I use the equipment?
Yes. You can use it. You
Yes.
can,
How
sorry.
how can I use it? The equipment is not installed. If I don't install it, can I use the equipment?
No.
So listen this. You purchase a fridge, which fridge is not plugged to the electricity. There's not connected to the water, nothing. Can you use it?
No.
No. Then if you have to install it, is that expense or part of
Yes.
the cost of the equipment?
Equipment, Professor.
Okay.
Make sense?
Yeah.
Okay, that will be part of the cost of the equipment. That's how we should look at it. The cost of the equipment, when we say the final cost, is that means somebody tells you, you can use this equipment for whatever purposes. If you cannot use it, you keep adding the cost to the equipment. Make sense? Do you understand this logic?
Yes.
Okay. Now, we have to test and adjust the new equipment before we start using it. What should I do with this cost?
No effect or equipment.
You're thinking right. Because the question is, can I use the equipment if I don't test it and I don't make adjustments?
No.
No. If the answer is no, cost of the equipment. If the answer is yes, then it's going to be expense. Now, let's give you another example here. If you have to purchase 1 year insurance on the equipment, what's going to be that?
That's expenses.
That's expense.
Okay.
Make sense?
Yes, it does.
So,
Mm.
until the machinery, until the asset is ready for use, all the money that you're paying for that asset is part of the cost of the asset. So let's say you purchase a dishwasher from Home Depot. Do you have to pay PST?
Yes.
Part
GST
of,
as in tax.
let's say we're a corporation. Let's say we're a corporation, we're getting the GST back. So we have to include the cost of the dishwasher plus the PST because we're not going to get it. The government's not going to give it back. Do we have to ship it to where we are?
Yeah.
Yes.
Part of the dishwasher. Do we have to get people to install it?
Yes.
Yes, we do.
Yes, part of the cost of the dishwasher. Do those people have to test it?
Yes.
Part of the dishwasher. Do we have to purchase detergent for the dishwasher?
Mm-hmm. Yes.
Yes, we do.
What's the detergent now?
The detergent is
Expenses?
expenses.
That will be expense. If you want to purchase warranty, what will be that?
Equipment cost or the
Equipment.
original.
Expense.
Uh-oh.
If you want to purchase warranty, that will be expense. Can you use the equipment if you don't have a warranty?
Yes, you can.
Yes.
Yes, you can. That's how you should look at the thing. Can I use the equipment if you don't have a detergent?
No.
What do you
No.
mean no? What do you mean no?
You can use it, but your dishes wouldn't be clean.
Well, that's not the point. The point is, can I use the equipment if I don't have a detergent? Yes, you can.
Yes, yes,
Yeah.
yes.
What will be the effect on the dishes? That's completely different question, right?
Okay.
Make sense?
Yes.
Yeah.
Okay. How about minor repair on some old equipment? What will be that?
Yes. Expensive.
Expenses.
Finally, expenses. You see, up to this point, we have only one thing that looks like expenses, and that's only its management decision. Up to everything is the equipment. So how much is the cost of the equipment now? 8,000 plus 3,000 plus 150 plus 6. So how much will be the total cost? Total cost will be 90,500. Make sense?
Yes,
Yes.
Professor.
Keep that in mind for your quiz. Because now this become a cost, not the 80,000, not the 86,000, not the 89,000. 90,500 is the cost of the equipment. And if there's a residual value, you have to deduct from the 90,500, not from the 80, from the 90,500 to come up with the depreciable amount. Careful with that on your quiz. So, major overhaul on the old piece of equipment, extending useful life by 3 years.
Equipment.
That's equipment. Why? Because extending the useful
Extending
life.
its life.
Right.
Mhm.
Routine maintenance,
Expenses.
expenses. And the last one is Replacement of window broken by some employee which getting angry that he didn't get like a payroll
Expensive.
increase. That would be expense. Okay.
For expenses.
Okay. Thank you. Thank you, guys. That was
Thank-
all from me.
Thank you.
Thank you, Professor.
Thank you, Professor.
You're very welcome.